Good afternoon, ladies and gentlemen. Thank you everybody for coming this afternoon. I'm James Taylor, I'm the CEO of Dragon Argent. I'm here with my colleagues James Kearns, who's head of legal, and Misha Patel, who's head of our tax department. What we're going to do today is talk to you about tax, but we're going to try and make it a lot more interesting than it sounds. We're going to talk about the tax incentives that we have in the UK that really fuel startup growth. The reason why we're quite well positioned to do that is because Dragon Argent are a professional services firm. There's two things that make us slightly unusual. The first is that we combine accountancy, tax, legal and advisory advice for our clients. And the second is that we focus very much on tech-enabled startups. And so the types of challenges that founders come up against and the experiences that they go through, like raising money, we have a lot of experience in that. And we bring those different disciplines together and offer very joined up advice. So today that's what we're going to try and do. We're going to try and take you through the landscape of tax initiatives in the UK that startups can benefit from, and hopefully everybody who's here goes away knowing at least one new thing that they can try to implement in their businesses. So before we start, I would just like to get a show of hands. Who here is thinking about starting a business? 1, 2, 3, 4, 5. Okay, who here has already started a business? Okay, who here is thinking about potentially exiting their business? Okay, fine. For this discussion, what we're going to do to try and make it as engaging as possible, we're going to do a scenario-based situation where I'm going to be pretend to be a founder of a business, and I'm going to be asking James and Misha what are the tax considerations that I should be thinking about at different stages. So for the purposes of this, I am one of 3 co-founders that is setting up a tech-enabled startup. We're going to be developing a B2B technology platform. I know that we're going to have to spend about 6 months developing that platform, that we'll probably need to raise investment to do that before we become revenue generating. We're likely to use subcontractors, and our technology is going to be very innovative. It's going to be new to the market. And each founder has saved up about £20,000, which we're putting into the business as the initial capital to get going. So that's our scenario. Okay. So with that in mind, Misha and James, the first thing that I've done is I've spent a little bit of my money buying some initial equipment, laptops and everything else to get going. That's come out of my personal account. What is the first thing in respect of tax that I should be thinking of with that type of expenditure?
Yeah, so James, you said you've put in £20,000 of your own money to start up your business. So that will be allocated to your director's loan account. So a director's loan account is basically transactions between a company and its directors. So the initial amount that you've put in, you can extract from the business tax-free, so there's no tax implications. However, throughout the year, if you do take out loans, you do take loans from your business or you do pay for personal transactions, we would ask for you to keep a record of these. Only because if at the year end you're in a debit position, meaning that you owe the company money, you will be charged to an additional tax of 32.5% if it's not repaid within 9 months.
Okay, so for the people that put their hands up, mainly who are over here thinking about starting a business, if you're incurring any expenses right now, you just need to keep a record of those expenses. Then once you get your business up and running, you can repay that money in a very tax efficient way. And that's something that a lot of people who are starting out don't necessarily appreciate. So it's a good thing to bear in mind. James, from your point of view, we talk about this quite often. There's a little trick that founders can do with one of the incentives we have, SEIS and EIS, in terms of setting the company up. Could you just maybe talk us through that?
Yeah, sure. Can people hear me okay? Okay, great. Yeah, you're right. A lot of people quite understandably rightly see SEIS and EIS as sort of tax advantages which incentivize investors, like high net worth individuals who want a tax advantageous investment. But what a lot of people don't appreciate is that under certain circumstances, albeit limited, founders of companies can actually benefit from SEIS as well. So I don't know what the individual situations are of the people starting businesses now, but in this scenario that you've given, James, you're talking about 3 co-founders. Well, it's actually possible for those co-founders to subscribe for shares in the company. So the startup capital that we've talked about, rather than taking it as a director's loan, invest it as equity from the outset, and SEIS benefits can be taken from those investments. The slight snag here is that before you commence trading, the equity ownership that you hold in order to retain that SEIS eligibility must be less than 30%. So if you're a sole founder, it's unlikely you're going to be able to dilute your position down. In fact, you probably don't want to dilute your position down below 30%. But if you're in a situation where you have perhaps 3 founders or certainly 4 founders with equal holdings, you should certainly consider SEIS benefits in that way.
And I suppose we might touch on this later on, but the benefit of that is not immediate, but it comes into play when you come to exit the business in the future, all being well. There are some significant tax savings that can be made at that point.
Well, absolutely. I mean, there's a couple of elements to SEIS. One is on the income tax side, and if you are investing some of your own cash, the benefit can be immediate. If you're just investing at par value and you're not putting in your own startup capital, the benefits will come out at the end on exit. Yeah.
Okay, so let's assume now that we've made some initial expenditure, we've got the company up and running, and we're taking that 60,000 that each of the founders are putting in together cumulatively, and we're starting to spend that on developing our platform, developing our technology. What is the next tax thing that we should be thinking of in terms of investing in innovative technologies that we might be able to benefit from?
Yeah, so James, you said, you're bringing a new product to the market. It's quite innovative and it's not been developed yet. So with this in mind, you can qualify for the R&D tax credits. So R&D tax credit scheme is available for those companies that are looking to develop a new product, process, or a system. And even if you're making improvements to one, and if you have a project that goes beyond using the existing science and technology capabilities out there, then you will definitely qualify. So for loss-making businesses, you can claim back up to 1/3 of your expenses under qualifying R&D expenditure. So this could be a cash credit straight into your bank account, or it could be as a tax deduction from your corporation tax profits. So as a profit-making company, you could claim back up to 25%. So it's a great scheme that every company should look into. If you're developing something new using science and technology. You also mentioned that you're going to be hiring subcontractors. Now, one thing that HMRC has changed in the legislation is that from April 2023, they will be restricting costs made to subcontractors used overseas. So generally, they restricted the cost only to UK subcontractors. So as a startup company where you have got cash flow restrictions, you need to weigh up the cost benefits. So do you hire someone overseas at a cheaper rate, or do you hire someone in the UK and claim back 1/3 of their costs?
So I think that's a really important consideration, as you rightly said. If you are using any service providers, any subcontractors outside of the UK, after April 2023, that's changing. Those costs will no longer be eligible.
Absolutely, yeah, correct.
But that is a really important tax incentive that startup founders should be aware of. If you are spending money on qualifying costs, it can make a big difference. You can reinvest that money. That can help you grow and scale quicker. So it's a really important thing to be aware of.
Yeah, absolutely. You can use that to help commercialize your product.
So on that idea of using a remote workforce, obviously since the pandemic, that's become a lot more the norm for companies to look outside of the UK to use talent that might be based elsewhere. Are there any tax risks or considerations that people should bear in mind when they use a remote workforce?
Yeah, absolutely. So COVID has changed the way we work, and if you are looking to hire employees working remotely, overseas, then you need to take into consideration that there can be local sales and employment tax risks. So we need to understand what activity you're undertaking overseas and if you're meeting all the compliance obligations.
And I think I'm not a professional, so I'm not a solicitor or a tax advisor like my colleagues. I think as a founder, there is a commercial decision to be made where you might be using one subcontractor in another jurisdiction. You may not immediately set up a permanent establishment there in order to start paying employment tax. Yeah. But what you would do is identify the tipping point at which you feel the risk of basically being fined for not doing that becomes too high. Is that fair to say?
Yeah, that's absolutely correct. Yeah. So you need to try and avoid creating a permanent establishment unless you really want to, and avoid creating that physical presence there.
Okay. So that's really the tax considerations at the start of the journey. Now, all being well, my 2 co-founders and I have built our platform. We're scaling. We're trying to get to the next stage of growth. And like a lot of people here, we need to raise investment to do that. So again, can I have a quick show of hands, people who think it's likely that they will need to raise investment at some point on their journey? Okay, so again, a good number of people. So James, what are the tax considerations that come into the journey of raising investment as you scale your business?
Well, we've already talked about SEIS and EIS, and in this country at least, that is the principal driver of angel investment into small companies. So it's vital that as a founder you have an understanding of the tax benefits, not least because that will inform your investment strategy, the way you go out to potential angel investors. It also is quite useful in a sense because of the great tax benefits that EIS and SEIS affords. The government have made sure they've attached various conditions to the eligibility behind SES and EIS. So, for example, you'll have certain investors who might come in and say, I want preference shares, I want a preferential dividend, or I want anti-dilution rights, and they might have a list of demands that they have as a condition of their investment. The beauty of SEIS and EIS is that all of those things would render their investment ineligible under those tax schemes. So what it can do is simplify your negotiations slightly with angel investors. And that's definitely worth bearing in mind. It may also have an implication on timing. Towards the end of the tax year, you'll have serial EIS and SEIS investors who are looking to fill up their allocation. That can sometimes be a bit of a lever to try and get them to onboard their investment before tax year end. The flip side of that, and it's just something to be aware of, and again, I don't know who in the room, what stage of investment you are at, but once you reach sort of Series A, when you're looking to speak to VCs, that kind of goes out of the window because VCs, unless they're some form of hybrid EIS fund, don't have those considerations. So that simplicity is removed, and they will almost certainly look to introduce some more of a preference structure. So it's just worth bearing those kinds of things in mind.
And I think that there's a really important point right now, which is that one of the things that has stuck out of the disastrous mini budget that we had was that there's been a change to SEIS and EIS limits. So as we approach the end of the tax year, there's a consideration there for founders?
Absolutely, yeah. So, and Misha may need to correct my figures here, but we have, there's a maximum company limit on SEIS of 150,000 in a company, but that is being increased to 250,000 as of April. So if you are approaching investors in the next 6 months, that is an additional incentive to get something over the line, and you could potentially use certain mechanisms to complete their investment post-April in order that they get a benefit, the increased benefit. Sorry, I should say that applies to individual limits as well, which are being increased, not just the company limits.
And again, you started to touch on this, and I don't necessarily want to deviate too much from the tax theme, but because there are quite a few people here who are planning to raise investment, I think there's an important consideration when it comes to investing in your corporate documents, depending on who you're likely to raise investment from. And there's a difference, isn't there, between an angel investor and what you might put in place in a VC?
That's right, yeah. So for those who are on that journey, I think the approach that we tend to take, and we see all the time, is when you're negotiating with a VC or any kind of institutional investor, you can pretty much forget about them signing up to your existing documents. Whatever existing documents you have, they'll come in and rip up and they'll want to replace. But until you reach that point, we always tend to advise that you create sort of founder-friendly documents, but which are also have sufficient provisions to be attractive to an investor. And when you come to your angel investment round, you present that to those angels almost as a fait accompli, just sort of sign on the dotted line. And we find that is a very effective way of doing things. They just sign a deed of adherence to existing documents. As long as they're reasonable, they tend not to try and renegotiate.
Okay, so it's the key point there to take away is that if you think it's likely that your first investors are going to be VC type investors who are going to rip up any existing documents you have, it doesn't make sense to spend a lot of money developing those and getting those in place. Conversely, if you think you're likely to raise investment from angel investors first, they will subscribe to your existing corporate documentation. It makes sense to spend a bit more time and money on those.
You do get the odd awkward angel investor, of course, but on the whole, yes.
Okay, so now let's just assume we've successfully raised investment, we're fully funded, We're working on the MVP of our product, and now rather than using subcontractors, we want to bring some talent into the company and have them incentivized to help us build and scale the business over the long term. What are the most effective ways to do that? And again, the tax considerations of those.
Well, generally for companies of this nature, the one in this scenario, the most effective, most tax efficient way of incentivizing employees is by way of EMI, which is a sort of an equity scheme, again, tax advantageous, which essentially means you can grant options to employees over shares. So it's a way of granting equity to employees. That is the main scheme that we deal with and that most companies at this level tend to deal with. There are certain conditions which are attached to that, and so you need to be eligible, but most companies in this stage of their journey tend to be.
And what's the tax benefit of an EMI option scheme? Is that primarily for the employee or for the company? What's the incentive behind that?
It's principally for the employee. So imagine you have a company which, again, in this scenario, the company is now grown in value. If you were to simply issue to your employee a batch of shares, those shares will have a value. And in the same way, if you gave a member of staff a £50,000 bonus, they'd have an immediate tax bill. If you were to issue them with £50,000 worth of shares, they'd also have a tax bill. So obviously, it's not the biggest incentive for an employee to be presented with a big income tax liability, albeit they get some shares alongside with it. So in order to get round this, EMI is a scheme whereby HMRC pre-approves a certain valuation, a decreased valuation of your company, or specifically of your shares, and then you grant options over those shares, and provided that the price at which the employee ultimately pays for those shares upon exercise of the options is the same as or above that pre-approved price, then they will pay no income tax when they acquire the shares, which they otherwise would.
Okay, and
yeah. So for those who didn't hear that, point made was shares can be taken back if an employee leaves. Yeah. So the terms of the EMI document would essentially say if someone leaves, if they don't have their shares in hand, their option just disappears. So yes, as soon as someone leaves, a standard EMI document would say that their options would just fall away and they would never get to actually own the shares.
And James, you touched on the idea that not every company would be eligible for EMI options. So are there alternatives that you can tap into?
There are. So there are certain eligibility requirements. I won't go into them into detail, but one which affects professional services firms like us is that certain trades are not eligible to grant EMI options. So in those instances, one potential option is to create a class of new share called growth shares. And that is a way in which you can, again, get round the problem of issuing shares to employees and handing them a big income tax bill. So I don't know if you almost go into a bit more detail as to how that works.
No, I think that's fine, because I think we're covering a lot of ground here. So obviously there's a lot more that sits behind some of these things, and something I was going to mention was we'd be very happy to take questions at the end or to have one-on-one conversations, but that's good. And Misha, so we're talking about a lot of the sort of, I suppose, the more complex or sophisticated tax incentives that we have, but what are some of the tax obligations that a founder has once they incorporate a business and then is just running that business on an ongoing basis?
Yeah, so absolutely. So as your business grows, you'll be looking to hire employees. So the company has to make sure that you file monthly payroll. So make sure you deduct the correct tax and national insurance contributions. Once you become revenue generating and you start making profits in the business, you will have to pay corporation tax of 19%, which is actually set to go up in April 2023 to 25%. And as you become revenue generating and you hit a threshold of £85,000, you will need to submit quarterly VAT returns.
Okay, and then the last question really on this phase of the business is that as a founder, I've set my business up, I've been running it, I'm working very hard. I now want to start taking some money out of the business. What are the typical ways or the mechanics that we see clients do this? How do founders take money out of their businesses?
Yeah, so as a director, founder, you want to make sure you extract the profits in the company in the most tax efficient manner. So as we know, income tax rates are higher than dividend tax rates, and every individual is allowed a personal allowance of £12,500. So what we suggest to directors is that you take enough salary so you meet your state pension in the future, but avoid paying national insurance contributions. And then you top yourself up with dividends. Every individual has a dividend allowance of £2,000, absolutely tax-free. So we would urge you to, completely make use of that if the company has enough reserves to do so.
And I think for us, a lot of our clients that we see are those types of tech businesses that require a lot of investment in order to scale and to become revenue generating, let alone profit generating. And so when you go to a VC investor, it's likely you're going to be unable to pay out dividends if you're not profit generating.
Yeah.
So what do we see founders put in place in those situations?
So in that situation, you would just take a salary. Unfortunately, if you don't have enough reserves, then you won't be able to take dividends till a much later date. But you can take a loan out from your company if you do require it. But like I said earlier, please do keep on top of what you're taking from the company and what you're loaning into the company, because that could result in an additional tax charge.
Okay. So now we're going to fast forward massively. We've got a fantastically successful business on our hands. We've taken investment. We've launched our product. We've got customers. I'm now thinking about an exit. I want to realise some of the value that I've worked incredibly hard for. What are the tax considerations on exit of a business? Because obviously a lot of the value that I've created for myself is retained in the business. This is the point at which I'm likely to get a big tax liability. How do we navigate that?
Well, this returns to one of the first points we made about SEIS, and one of the reasons that if you can get it right and the conditions do apply, if founders can make the most of SEIS, subject to that 30% rule that I was talking about, if you have SEIS shares originally as a founder, you would not pay any capital gains tax at all on the sale or on the profits of the sale of your company. So that's one of the reasons why it's definitely worth considering, even if it's not always likely that you'll be able to fulfill those conditions.
And so just to put that into kind of real terms, if I'm going to sell my business and I'm set to make £1 million out of the sale of my business, and I've done that under SEIS, my shares are under SEIS, I don't have to pay capital gains tax at 20%. I've just saved £200,000.
Exactly, yeah.
I'm delighted that my maths was correct there. So
and so again, most people won't fall into this category, and so the other thing to consider, which I'm sure most people will be familiar with, is entrepreneurs relief, which has been since renamed business asset disposal relief. And essentially the idea there is that whereas capital gains tax is currently at 20%, you will actually only pay 10%, subject to fulfilling certain conditions. Principally that for the 2 years up to the date of the sale, you should own at least 5% of the shares, and you should be an employee or a director of the company, which most people should fulfill as a founder.
Okay. So that pretty much takes us very quickly through our whistle-stop tour of the tax considerations and the tax incentives that fuel startup growth. What I would like to do is ask if anybody's got any questions. Just before I do that, I'll give you some time to think about it. I will just say that Dragon Argent as a business, we offer what we call discovery calls to everybody, which is basically the opportunity to book in a free 30-minute consultation with us to talk about any of these types of things. The QR code on our banner here will take you through to that, or you could come to our exhibition booth, which is B1502, but you can just turn right out of here and you can come and talk to us at the booth as well. And just to recap, I think the things that we've touched on very, very quickly have included SEIS and EIS, R&D tax relief, EMI option schemes and other option schemes, VAT, corporation tax, national insurance. There's an awful lot within the tax landscape that you have to navigate as a founder. Some of that, especially in the early days, you can do it by yourself. But I think even that last example that we gave, where you can mitigate, some people can mitigate, capital gains tax at 20% if they, navigate this tax regime correctly. It can have a huge impact, and so getting the advice of professionals, getting some input, can be really, really valuable. So with that being said, does anybody have any questions for us? Yes, please.
Thanks very much. I like the interactive nature of this. if you were talking about you needed to own less than 30% of the shares to do the SEIS, does that mean you have to have 29.9% or does 30.0 count? But also, could somebody, if they had 35% or 45%, give 15% to their children? Or would HMRC, especially if the children are under 16, say in effect that you're still controlling, or is that a clever way around?
Yeah.
Thank you. So 30% is absolutely fine. You don't have to hold any amount lower. And in terms of your question around if your children can hold a certain percentage, well, for SEIS and EIS that isn't allowed. However, siblings are allowed to hold a percentage of your business. So that one way you can make it more tax efficient for you is maybe getting your brother or sister, giving them some shares to bring your holding down to 30%.
So for some reason HMRC have focused it on siblings. That's okay. Parents, children aren't okay.
Yeah.
Any other questions at all? Yes.
So as well as the SEIS amount going up in April, am I right in thinking the window is also becoming bigger as well? Is it still 2 years or has it become 3 years?
No, it's still 2 years,
Right.
but you can use the higher limits now by issuing a certain document called Advanced Subscription Agreement, and that is something we can definitely put in place for you if your investors require. So.
Okay.
So I'm pretty sure, again, confusion, but I think from April, it will go up to 3 years from when the company was formed that you can do the SCIS. It's up to 2 years until April, but from April, there's a up to 3 year window. So, I think we're both
okay.
cross purposes, but yeah. People might have guessed I'm a happy Dragon Argent client who are the young company that's doing really well and has done brilliantly because of your advice. But one thing that was really helpful, it was having an opco and a holding company structure so that if you go overseas, you don't get caught out by different tax regimes, plus you own the IP at the holding company such that if you come into a dispute with somebody, etc., you've got an operating company that you can, in theory, close down, restart, shouldn't be de-phoenixing, but sort of things. I just wondered if it's worth touching on that.
Yes, thank you. It's somewhat slightly outside of the tax thing, but this is a piece of advice that we would give to pretty much all of our clients at the point at which they're thinking about starting up a business. And really best practice is to create a holding company and an operating company. What that then enables you to do, as Peter said, is all of the value that the business is built on, your intellectual property, the investment that you've raised is kept in the holding company. And then all of your commercial engagements, whether that's with clients, suppliers, employees, they sit at the subsidiary level. And it just means if you get into any type of dispute that could prove to be terminal for the business, it's ring-fenced and is isolated in the operating company, and all the value is protected in the holding company. It also gives you a lot more flexibility for events that might happen in the future, going into joint venture partnerships, expanding into overseas territories. And then if those things happen to go very well, you can sell parts of your business while retaining the holdco and the other subsidiaries that you have. So that's just a standard piece of advice that we would give to people thinking about setting up a business. I don't know if either of you guys want to expand on that at all.
No, I think that's
Nailed it. Any more questions at all? Yes.
Hi, I do have a company now, and I'm starting my second company, and it needs a cash injection of, let's say, £10,000. So if I withdraw that 10K from that company, is that going to be subject to any tax, or is it going to be considered as an investment?
So because you initially injected that £10,000 into the company, you can take it out tax-free. Yeah, as long as it was the initial investment to get your company going, that's absolutely fine.
But I think the point that the gentleman was making is he's taking £10,000 out of one company that he owns and putting it into another company which aren't in a group structure.
Oh, right, okay, yeah, so there would be tax implications to that. Yeah, you'd have to loan that money back into your company if you do take it out.
So that's something else that's related to this idea of having a group company structure, is then it becomes far easier to move money between companies, whereas if they are arm's length separate entities, even if they've got the same ownership, you are effectively loaning that money between the two businesses and you would have an intercompany loan account on your balance sheet. Whether that attracts tax or not, I don't know, but you would have to pay that money back at some point in the future. Well, that takes us through to 1 minute before the end of our session, so we've timed it very well. Thank you very much, everybody. Thank you.